Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
All right, welcome everybody to episode number 2 of True North Wealth Partners Vantage Point. Friday, August 7th, 2020.
Where's the year going? Where's the summer going?
That's right.
Kids going back to school. What?
Is it 2021 yet, right?
Yeah.
Day 10,000 of the COVID lockdown coming to you from our cave here. So hopefully everyone's doing well and staying safe and being able to find some joy, I guess, from the craziness that we're in still. So I guess top of mind awareness, right, is kind of the COVID, the virus is still obviously front and center, kind of.
Yeah, it is.
What's going on?
Yep. Now, with that, it was interesting. If we recall the last month episode, we shared with you the sort of the spike that we were going through at that time. So we believe, at least the spike up that has occurred over the past 3-4 weeks is now waning and turning back down. And you can see that in addition, follow the U.S. spike line there. It goes higher, then it's turning back lower. So we're pleased to see a little bit of a relief. But obviously that is something that is still top of mind because you have to have a remedy. They're talking about hopefully a cure or some type of vaccine there by the end of the year. That's top of mind. So the markets are anticipating that, bringing in a lot of the forward earnings and guidance there as far as market anticipation. So they are responding accordingly. So what's with the First Trust, you'll notice as well how plenty of graphs. It's a little busy of a chart, but again. India, surprisingly, is jumping off the charts. So I know they have tons of people over there living there, which sort of makes sense. But you'll see, besides the United States, India is another one that's really going through their phase of that aspect. Yeah. So hopefully, as we get in, there still could be another resurgence of a spike in the fall. We get back to school. Whether it's full-time school, partial, right, online.
Yeah, a mixture, crazy for sure. But make it a little more difficult for families.
Yes,
especially when they're both dual working situation, kind of some craziness. We've had some, even in the office building here, we've had a couple cases where they have to evacuate the building and kind of put it in lockdown, and they come around and spray everything.
Spray everything. Get the fumigate.
So I think that's just an excuse to get us out of the building, so they can get the stink out, I guess.
No, I hear you. So we're obviously monitoring that, and you've seen those pieces. Moving on, I guess in regards to the trading volume, it has decreased. It was a 5.7 billion trades on average. Now it's down to 5.5 billion trades on average just over this month. And the drop off for that, just recently, as yesterday as an example, hitting new highs now here in the markets. And now we're at 4.1 billion trades. So we're well below the average.
And that's per day, right?
Per day. Great point.
And we talk about trading, that's stock trading,
mm-hmm. Yep.
A buy and a sell.
Buy and a sell.
So a buy would be one trade and a sell would be another.
Correct. That is correct. That's what the trading volume is. And, I've been following that. I started tracking this in my days of T. Rowe Price, and I used to work there in the late 1990s. Learned from the fund managers and things of that nature. But it just non-emotionally helps you track and it gives you guidance of where one sees. People say, okay, Eric, well, what does that mean? Okay, well, we're still up 41% over trade volume from last year. So it's still high. It used to be 47. It's coming down. Now it's only 41%. That comes from me. I track that, as you know, on a daily basis pretty much. Let's see. Moving on, I guess, as far as the VIX.
Yeah.
So the volatility, or lack thereof.
That's right. So the VIX is So that's just VIX, right? That's
Correct.
That's the term for it.
Yeah, so that's the volatility. The symbol's VIX. So what that means is basically the next 30 days out, what the traders and the traders think that the stock market is going to do. So right now, as you can see on this chart, again, this is through Sentiment Trader. So with that, Sentiment, as far as one of our resources and partners that we use in our research team here, you can just see it's just rock bottom. So it's gone off the chart down low. So it's approaching right now 0.8. So 0.8 is the contractions below or touching that red line. And again, the markets, the traders are getting comfortable with where things are at. That can be good, but it can be bad. So when it turns fast, and hence why the volatility and the trading volume will then spike back up. So right now the trading volume has spiked down. It's going to turn when there's uncertainty in the air. So there's plenty of issues still out there, but that's another chart, and I think you'll find the VIX, the term structure, as far as the 30-day and 90-day, how they do that. So
So basically, so when stocks start to sell off, then the VIX goes up.
correct.
Okay.
Yes, that's exactly right. And you'll see that there on the chart, indicating the spike up in volatility. Along with that, so there's plenty of sources. You just can't go with one. We track over 50 economic indicators, or leading economic indicators, as well as coincident and then lagging. So those are three types of economic indicators. But with that said, the Fear Greed Index. So again, produced by Sentiment as well. They publish this, and you can see with the Fear Greed, we're near the highs again. So well over 80 there. So again, when that gets higher, along with the VIX, these are just indicators as to why we have been waiting for a pullback in the market. So things that we're tracking and showing, again, nothing's perfect or foolproof, but there should be an opportunity, and hopefully here in August. So August and September are typically one of the best opportunities to redeploy cash, because the markets typically are the worst in August and September. So
That's right.
we will look to do that as well. So we find this as another source that we use as well.
Yeah, good. Yeah, it's hard to, when you're talking about the markets, I know we talk about this a lot, but just trying to give the markets time and space to work out. I know earlier we were talking about doing a rebalance, I think in like June, July, and just trying to extend it a little bit to be a little bit more cautious. But on top of the VIX, though, one of the charts or one of the indexes that we look at that you'll see here on the screen is the big money index.
Big Mo.
The big Mo, the buy sell index. So this just shows what we call the big money. It's the chart here that you're seeing is from Palm Beach Research Group. And it just picks up on what it says there, the big money. So big money would be, we think of trading in the market would be like the pension funds, the mutual funds, the companies that are buying and selling large quantities of shares.
Institutional.
Yeah, or another word we would say would be institutional buyers or sellers. So it's not necessarily, Andy
The Robin
Smith,
Hoodies.
Yeah, Andy Smith or Eric Susie going out and buying, 2 shares of Apple. That really doesn't what we call move the market one way or the other. It's the big guys or the big money. And so this chart here will show you that the 2 lines there. The red line is what we call overbought. And that's kind of picking up on what Eric was talking about that we call fear greed. So once you pass the red line, you're in kind of an extreme greed situation where basically it's showing us that stocks are very much overbought at that point. And so the average, so since 1990, there have been about 19 overbought periods in the market. And so the average period has lasted about 20 trading days. Mm-hmm. And so right now we're into, I think at the time of this chart, 63 trading days into overbought territory. And so that just shows you right now, money, big money's still kind of going in. There's not a lot of selling going on at this point, but it's just an indicator that that if you're going to be putting new money in, now's not the best time to be doing it because
Correct.
we're kind of at the tops of the market. And so what we wait for then is for that to come down below the kind of the fear greed line, and kind of reverse too. As you get into the green, you get an oversold territory, or we call it extreme fear, which we saw there back in February, March.
And also with the seasonality. So that will time up perfectly with August, September. So
That's right, yeah.
I know, like Andy mentioned, I'm not called daily with the hedge eye. Space and time.
Yeah.
We got to have a little bit of patience. And yes, to the point, as far as our models, we are lagging a little bit to the appropriate benchmark. And the benchmark that we do follow is called the Dow Jones Portfolio. Moderate Portfolio Index is the one assigned to basically to the middle of the road for our model number 3, which most of our clients' assets reside in. But so again, that can change in a day or two just as fast. So we will be doing that. And moving on to the next topic, I guess, is in regards to leading indicators, things that we follow. That would be called high frequency data points that we track. So with that, I'm just going to rattle off just a few because there's so many of them, over 20. But initial jobless claims is one, obviously. Weekly retail sales, box office receipts, hotel occupancy, gas, TSA checkpoint for flights. All that stuff, rail car. So, as a kid growing up, I used to count trucks on the road, so freight. So that was a leading indicator. So, long haul truck, but another way is the rail car and traffic cars. So, again, month over month, week over week, as they track the high frequency indicators, they're certainly getting better over the past few months. So there's plenty of green that we're seeing there. But it's all about the ROC. The ROC is ROC, rate of change. So with the ROC rate of change year over year, everything's lagging. Down, 800% on one, 99% for box office receipts. Steel ton is down 30%. Hotel occupancy down 39%. Open table. That's the restaurant industry.
Yeah.
With restaurants, down 66%.
Sure.
And you know this, but I have a close friend of mine that owns a couple restaurants, and I pop in, I keep tabs with him, so he gives me up to date information too. And it's let's just say it's a challenge. He's struggling, so we hope that will change. And as far as for folks, what to do with your stimulus once the Fed passes their next package of trillions of dollars, utilize that, spend it. As far as ideas, where to put it. 529, just things top of mind. That'd be a great idea of what to do with money. Pay down debt if you have it, please. Right, Andy? For financial planning wise.
That's right.
Don't be afraid to do that. Loans, credit cards, shore up your own personal balance sheet. So that would be, have a rainy day fund. There's tons of savings rates. It's huge now in the high 20s. So
growing. It's good.
Yeah, that's good. But you have to have that rainy day fund because these good times, quote unquote, will not last forever. That's for sure.
That's right.
So getting back to, I guess, some more of some charting and things of that nature. It's funny, the 6 we call the FANGs. Okay, so folks, in regards to the Facebook, Amazon, Netflix, Google, Apple, and Alphabet, what have you, Microsoft. So those 6 companies on this chart that you're seeing, it's amazing how it's cap weighted, so it's highly for the larger QQQ type companies, which is a NASDAQ. But with that said, it's amazing on this how basically these, from the beginning of the year through 8/3, based on this chart, and this is from Day Hagen, by the way. We're on a webinar this week about this. It's up 40.34% for those 6 companies alone.
So 6 out of how many companies?
500. This is the S&P 500 index here, so they're just isolating that. And then of which the S&P, okay, it's up 1.98. Okay, great. But what really tells the tale here, and it says a lot, is speaks volumes, is 494 companies. So out of the 500, 494, X the FANGs, are down minus 5.8%. So again, 494 companies on average are down minus 5.8%, and that's through 8/30 of this year to date, based on our Day Hagen and the webinar we're on. So we find that very enlightening that we have been talking about all along how narrow disconnect and how narrow this recovery is. So you have, let's call it 10, 15 companies holding up the stock market. So that's not good, folks. So, we've side on the cautious side, obviously. On this next chart, it shows you another way to look at it too. The percentage of stocks in the S&P 500 that are in a bear market. So bear market means from top to bottom a 20% decline. So with a 20% decline from top to bottom, you have basically almost 41% of the S&P 500 companies are in a bear market, meaning they're still down 20%. That's incredible. So again, almost 41%, again, based on Day Hagen there. But that speaks volumes again to the narrowness of what's been going on with the overall markets in general. You hear these terminologies you hear on TV, and the FOMO, fear of missing out, the Robin hoodies, the people staying at home, day trading. So with this fact, it came out too earlier, I think last week is when I heard it as far as the latest. There's approximately almost 25% of the trading volume now is due to retail investors.
Wow.
Which used to be around 10%.
You never see that.
No, So it's just spiked up dramatically. So again, not quite 25%, but that's huge as far as the folks staying at home, spending their PPP money and what have you.
Stimulus money,
the stimulus altogether. So that's something to consider. Commercial. We talked about commercial real estate.
With real estate, sure.
That's going to be a few years for sure. As far as trying people working from home, companies and CEOs are finding out they can do more with less. So unfortunately, some folks do want to work from home, i.e., my brother. So he's loving it. But there are folks that will want to go back to the office.
Sure.
And it's just about the office culture, too. So
absolutely.
But companies are saying, hey, though, they can not have to renew the leases or things of that nature. So the commercial real estate is in trouble for years to come. Obviously, we know about the retail. We've talked about that before. But the past week, things have been published on the wires. Ascenza Retail here, cutting over 1,000 jobs. L Brands, about 850 jobs. DSW Shoe Warehouse, cut over 1,000 jobs. Abercrombie, they're trying to refinance all their stores and offerings and store closures they expect. So that's just a rattling off just a few that came out this past week. So it's a lot going on with that.
Yeah, and just so you all know, if you're in a situation at work where there's a possible layoff or there's a decision to be made, please reach out to us. We've got a number of clients that obviously are working at big companies around Columbus, L Brands nationwide, just to name a few that are that we've helped work through some of these situations. So please contact us. We have the ability, the planning, the expertise to lay the numbers out and to talk through just different scenarios, real life situations, to just so you can have confidence when it comes time to make some of those tough choices. And that's why it's important to have a plan in place. We can always pivot, edit it, whatever we need to do, but just give you confidence. But please reach out to us.
And putting a bow tie on this in the retail, James Grant, another one of our sources that we use within the research center, on 8/6 came out. He stated over 25 companies thus far year to date has filed bankruptcy. BKO is bankruptcy, Chapter 11. So in trying to work things out, the companies are just filing bankruptcy in order to right size office space, employee count. So the jobless number that came out today, it's I'm glad there's over 1 million people getting back to work. That's fine, but it's a struggle. So it's going to be a long grind, like we've been talking about, as far as the economic damage that has been done, and still the ripple effects for years to come. We'll maybe transition on to the interest rates.
Sure.
Interest rates is another topic that's big. So interest rates, lower for longer. So that's the Fed. They're pumping, dumping, and as far as another stimulus, and they're still buying bonds, among other things.
Good for borrowers, bad for savers.
You got it. That's exactly right. Yeah. And so with that said, the Fed has mentioned over a month ago that they're not going to be raising interest rates anytime soon. At the earliest is in 2023. That's the earliest. Today, Goldman Sachs mentioned on one of their analysts and forecasters said that they don't see the Fed raising rates until 2025.
Wow.
So now, it's going to be a little over 5+ years. So which is on the same par for the Great Recession. Okay, the Fed didn't raise rates from 2009 to 2015. So rates are definitely going to be lower for longer, and like you said, hard for savers and anybody with. We're going to have a show and a topic on pensions down the road. It's going to be brutal for pensions, so we'll definitely talk about that at a different segment as well.
Yeah, definitely some headwinds.
Headwinds for that.
Sure, coming down the road. Yeah.
Mm-hmm. Hopefully you found this a little bit of information useful. We obviously will be doing these on a monthly basis.
Mm-hmm.
I look forward to the next episode as well, but always like to end on a tip of the month. So with the tips of the month, now we talked about cars, and OPM is other people's money. So interest rates are so low in regards to banks and what their interest rates for, like car loans and things of that nature. If you happen to need a car, great time to go out and buy a car. So a lot of folks, the majority of folks still do buy cars, but there are plenty of people that do like to lease cars just because they like to have something new every couple of years, which is fine.
Yeah. Mm-hmm.
But as far as management, financial planning that we do, we always strive to encourage our clients to buy and hold and own a car. Stacy, as you all know, she's had her car, her Honda, for almost 20 years, coming up in January here. I personally like to hold my cars for anywhere 14, 15 years. That was the last time I've held on to mine. I'm keeping mine now. I'm 5 years into it, and then another 10 more years I want to get out of it. And I think, Andy, yours is,
yeah.
You like to keep yours for a while? So.
Yeah, we have a 2007 Odyssey
Beautiful.
minivan. It's got about 220,000
there you
miles
go.
on it.
Just maintain it. Yeah.
And I have a 15 Toyota, yeah.
So just don't be afraid to just put money back into the car if necessary and buy a car. But if you do happen to need a car, this would be a great time because rates are low. And speaking of cars, so the IHS market data that came out is in print and dispatch here this week. People are keeping cars longer. So the little tip of the month on this is the average vehicle age as of the beginning of this year, January of this year, is 11.9 years. So 11.9 years is the average duration people are keeping their cars now, which is compared to what? The end of the Great Recession in 2009. Basically, at that time, it was 10.3 years. And then compared to 2002, it was 9.6 years. So again, 2002 was 9.6. 2009, 10.3, and 2020, it's 11.9. So people are holding on to the cars longer. They're more stable, durable.
Sure.
More features are being added to that. And then one more thing about the auto, because my clients know, and I'm a race fan. So anything that races, cars in general, I love it. So we'll end with some lower rates coming your way, folks. So for those folks who have State Farm insurance, I am not advocating State Farm insurance. I'm just stating a fact. It was in print as well from the dispatch this week. Their auto rates are going down 14.3%. So 14.3% decrease in auto rates will be coming your way, and I believe other companies will also be cutting. And the reason being, people are staying at home.
That's right. Yeah.
Less driving, less gas utilization, etc. So that's sort of where we're at. Put a bow tie on this, Andy.
Yeah. Thanks for joining us, everybody. Yeah, next month we've got a special guest coming in, Mike Gutteri.
Mike.
One of our strategic partners here. He does Medicare enrollment. And so we know that the open enrollment period is starting in October. And so we're going to talk to him about Medicare and possible changes that he sees on the horizon as far as Medicare.
Yeah.
And it should be a good conversation. He's good. We've used him for a number of years. Well,
we appreciate you tuning into this episode number 2, and you guys stay well, safe, wash those hands, wear the masks, and we'll see you next time.
All right. Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.